Meet Jack Bogle, the guy that saved investors billions of dollars without them even knowing it. Bogle is the genius behind index fund investing and the founder of the Vanguard Group, one of the top providers of exchange-traded funds or ETFs, managing more than $9.3 trillion in investments. But Bogle wasn't the slick Wall Street analyst you see pumping stocks on CNBC. He made his career telling us to stop pretending we're Warren Buffett and start being lazy with our money. Because being lazy means instead of trying to outsmart the market, instead of spending those hours researching trying to beat the market, just be the market with an index fund that spreads your investment dollars across all the stocks. Instead of treating the stock market like some slot machine in Vegas, getting all the stocks in the S&P 500 index, the largest 500 companies in the United States, and then sitting back and letting the market do its magic, making you money long term. Just that one fund, the Vanguard S&P 500 ETF, or ticker VOO, would have doubled your money in the last 5 years, a 15% annualized return. But that world of simple ETFs that Jack Bogle helped to create has been turned upside down in the last decade, and worse since his death in 2019. In fact, Bogle would be tearing down the temple if he saw what ETF investing has become, and some of the dangerous funds losing investor money. The number of ETFs in the US has exploded from 1,500 in 2015 to over 3,500 this year, more than 200 new ETFs every year. Assets in those funds has surged $7 trillion, worth more than $1 in $5 in the market now in an ETF. With that explosion in ETF popularity has come some pretty off-the-wall investing ideas. There's an ETF that only invests in pet-related stocks, several investing in companies with biblical values, and even one that lets you bet on the next K-pop sensation. And with all three underperforming just that basic index ETF by a long shot over the past 5 years. So in this video, I want to highlight the 3 best ETFs to buy, 3 Jack Bogle approved funds to grow your money safely, along with 3 ETFs you need to avoid. I'll show you those 3 ETFs to buy and 3 to avoid, but first I want to thank our sponsor for today's video, Fabric by Gerber Life. Some of these ETFs would be a great long-term investments in your kids' portfolio, but as minors, they can't open an account themselves yet, so get that ball rolling for them now with a UGMA Kids Investment Account in less than 10 minutes with Fabric by Gerber Life. A UGMA account is a special investing account that you can open up on behalf of a minor without the hassles of setting up a trust. With a Kids Investment Account by Fabric, you can start investing in your child's future today, and those assets pass seamlessly to your kid when they reach legal age. We all grew up with Gerber, and now with Fabric from Gerber Life, you can plan for and manage your family's financial path. And the best part is these UGMA Kids Investment Accounts carry special tax benefits. The first $1,250 income in the account each year is completely tax-free, and the next $1,250 is taxed at your child's rate. UGMA accounts can hold cash, mutual funds, stocks, and bonds, and the proceeds can be used for so much more than your similar accounts like a 529. You can use the account to pay for education, summer camps, sports, and when they're adults, it can be used to buy that first home or start a business. There are no contribution limits and no commission fees, and all accounts are SIPC insured up to $500,000. You can learn more by going to the link here, or I'll put that in the description below. Start investing in your child today. Go to meetfabric.com/Joseph. That's meetfabric.com/Joseph. Now I want to start with the ETFs to avoid here because for each I'll offer an alternative, a better ETF to buy, and let's start with the First Trust Alternative Return Strategy, ticker FAAR. And folks, there is nothing wrong with an alternative asset strategy. Now, I've highlighted others on the channel before, but so often, these just come down to the skill of the managers rather than any particular theme. When that skill is called into question, like with the paltry 5.4% annualized return on the FAAR, so really a stock that has gone nowhere since its inception, you have to put your money where it's going to work harder. Against that 5.4% annualized return, just a broad ETF covering the S&P 500 has made a 15% a year return. It's a difference of 89% in the return on your money. Now, the lesson here isn't that you have to invest in a plain vanilla index ETF, but that you don't need a complicated strategy to see those strong returns. The Real Estate Sector Spider Fund, the XLRE, invests in the largest real estate companies in the US, and after taking a hit on those higher interest rates over the last couple of years, is now the top performing sector over the last year, up almost 36%. Even better, the XLRE, with its simpler strategy, charges an expense fee of just 0.09%, less than a tenth the 1% fee you're going to pay on more complicated alternative funds. We've got 2 more ETFs to watch and 2 to avoid, but I'm not just talking about the ETFs that have lost money, especially on the short term, because over months or even a year, bigger picture economic forces can drag down good ETFs down with their theme. A lot of bond ETFs like the iShares US Aggregate just went through more than 2 years of losses as the Fed raised rates and destroyed bond prices. It doesn't make them bad ETFs, just the wrong theme at the wrong time. Instead, what we're talking about with these bad ETFs are the ones with real structural or thematic issues that virtually guarantee you don't make as much money as you should. For that, you can look to 3 factors that separate the good from the bad, starting with diversification in the theme. A good ETF spreads your risk out, like with the expanded tech sector ETF, the IGM, where even though it's focused on tech stocks, it still spreads that risk across 281 stocks in different sectors, end users, and industries. Compare that with the Pet Care ETF, ticker PAWZ, which holds just 28 stocks and is in a very narrow theme that could see all the stocks fall together. Expenses are another factor separating the good from the bad here, and too often overlooked by investors. Investors rationalize that paying a 4.6% expense fee isn't too bad if you're getting an 11% dividend, like with the Amplify Income ETF. But that expense fee can drain your returns fast, and there's almost always a better alternative, like here with the JP Morgan Equity Premium ETF, the JEPQ, with its 9% yield and expense fee of just 0.35%. Now then, the hardest to assess, but often the most important, is just an ETF's theme and the rationale for why it should produce outsized returns or lower risk. ETFs like the Amplified Data Sharing ETF, while narrow in scope, are based on the idea that revolution in data management and sharing are going to bring growth to those companies. On the other hand, folks, I know you love your pets and maybe you feel deeply about moral values, but it's a stretch to say that these themes, like the Pet Care ETF or those Bible funds, should produce those higher returns. In fact, I'm going to show you data later that may just be the opposite. Here, I'm going to highlight the Ultra Pro Short QQQ next, ticker SQQQ as an example, but I'm really talking about a whole group of ETFs and a strategy mismatch to avoid. Now, these Ultra ETFs use futures and other derivatives to produce a return 2 or 3 times the benchmark, and in the case of the Short QQQ, a return opposite to the Nasdaq. And these ETFs are actually fine for day traders or very short-term ideas, but most investors don't really understand what's going on here, and they hold them like any other ETF or stock. The fund's website even points out this mismatch problem, noting the fund's daily investment objective, and quote, noting that for any holding period other than a day, your return may be higher or lower than the daily target, and the difference can be significant. The more extreme index changes and the volatility gets, the longer an investor holds the fund, the more that 2 or 3x functioning is going to break down. So besides the loss over time on short funds, as stocks just return to that upward tendency, these ultra-short ETFs are also very expensive, with most near a 1% expense fee. So instead, if you want a solid long-term ETF, I like the iShares Expanded Tech ETF, the ticker IGM. And here, while most of you are probably more familiar with the NASDAQ 100 ETF, the QQQ, as tech stocks investment, I like the IGM better. That's because the QQQ invests in the 100 largest non-financial companies on the NASDAQ index, which tend to be more tech stocks, but also you've got a lot of decidedly non-tech companies like Costco, Pepsi, and T-Mobile in the fund. The IGM, though, is all tech all the time, with shares of 281 companies in the tech sector and tech-related communication services like Meta, Apple, and Microsoft. The fund has returned an outstanding 19% annualized over the last decade, and while there's no guarantee that this continues, this is a great long-term pick on the future of tech. We've got our next set of ETFs, one to watch and one to avoid, but I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Our third ETF to avoid is any socially driven or exotic investing theme. And yes, I know I'm going to take hell for this in the comments, but it's not just my opinion. Listen, folks, you can save the world and you can make your money work for you, but you shouldn't try doing both at the same time. In fact, it's precisely because some investors avoid them that the sin stocks trade at a discount and then outperform, with portfolios of tobacco, alcohol, gambling, and defensive stocks returning 8.3% in a recent study versus just 7.2% for stocks in the FTSE Social Index Fund. So instead of an ETF built on exclusion, which stocks to avoid, try one that includes all the stocks on the market with the Vanguard S&P 500 ETF, that VOO. This one fund gives you all 500 stocks in that broad stock market index, the largest companies in the United States, and about the lowest expense ratio you're going to find in an ETF at just 0.03%. It's the ultimate Jack Bogle fund. Get started on your kids' future with a kids investment account and Fabric by Gerber Life with the link in the description below. Or click on the video to the right to see how to invest $1,000 for dividend cash flow every single week. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.